Welcome to Wealth Plan TV. Today we're talking about accumulation. You remember that last time we spoke about accumulation we built a table that weighted our portfolio. This allowed us to analyse weightings for each different asset class. And while that was interesting, we covered that ground so we could talk about asset allocation and particularly the difference between strategic and tactical asset allocation. You remember the table we generated last time looked something like this. Tactical allocation seeks to trade a portfolio to take advantage of value mismatches as they appear in the market. This is shorthand for trading a portfolio to try and make money. Strategic is based on a portfolio mix which is founded on an expectation of risk and return. The action of the manager serves to rebalance that portfolio at regular intervals back to the portfolio mix. I know this sounds a bit vague, but I'll come back to this. Terry Burnham, in his book Mean Markets and Lizard Brains, raises two important issues: the market and us. Firstly, he claims that the amygdala, the lizard brain, is hardwired to cause us to fail in modern investment markets. The lizard brain is hardwired to fulfill basic functions, such as breathing, vision, body movement, etc. The danger for investors is that the amygdala takes over from the thinking part of the brain, the prefrontal cortex, when it senses danger. The amygdala is a patterning brain and it controls flight or fright. Can you imagine two of our ancient ancestors wandering down a jungle track and there's a mighty roar and one of them just takes off? His patterning brain, his amygdala says, "Mate, this is pattern, you hear a roar, you run," and that's what he did until he was exhausted. His friend, who is the first example of thinking man, stops, associates the sound to an animal. Knowing different animal types, he reviews the noise and determines that the animal that's making the noise is a meat-eating animal. He then assesses the volume of the sound and determines that the animal that's making the noise is rather large and consequently fast. So just as he's concluded that it's time for him to leg it off, the animal jumps on him and eats him. So you can see that thinking men didn't have a lot of chance of surviving in our ancient history, and you can also see why the lizard brain works. Behavioural finance studies the effect of our mental biases caused by our lizard brain. I don't want to turn this into a behavioural finance dissertation, so just a couple of examples. Loss aversion. It helps explain a lot of irrational economic behaviour. Bad investors exemplify this. When an investment goes down, they tell themselves that they'll sell it as soon as it goes back up. But when it continues to drop, loss aversion kicks in and they want to hold the investment even though it's making more losses. This is referred to as chasing a loss. It typifies the tendency to assess equivalent gains and losses differently. Framing is another example. Here are a few examples of framing. Would you prefer to eat meat that's 85% lean or 15% fat? Would you rather opt for an operation that had a 90% survival rate or a 10% mortality rate? Would you rather get a $5 discount or avoid paying a $5 surcharge? You get the idea. We rate buying and selling, we rate the value of money differently. Finally, the endowment effect. The value you place on something you own being greater than on buying it. In an experiment in an American finance university, they gave half of the students a cup with the university's name on it, and then they directed the students to sell the cups if they could. The people who owned the cups wanted $6 for them, and the people who didn't have the cups weren't prepared to pay any more than $3. Okay, I'm aware of 11 biases in relation to behavioural finance, but the point is that I'm trying to make here is that really we're ill-prepared to operate in a modern environment. Back to Terry Burnham's book, the other part of his story is mean markets. He dismisses the theory, well probably it should be a hypothesis, of efficient markets which underpins many of our financial decisions. Efficient market theory suggests the price of any share reflects all the information known about it, and as the information changes, so does the value of the share. And because efficient market theorists like to have a bet each way, the efficient markets theories are also defined as weak, where it's not quite right, semi-strong where it's sort of right, and strong where it supports the theory. An interesting story defines the value of both information and inertia in a market. Rothschilds, through their banking system, supported both sides of the Napoleonic Wars. That meant they were able to set up a courier system across enemy lines, so Mayer Rothschild was incredibly well informed in relation to what was going on. In 1815, he knew the outcome of the Battle of Waterloo a full day before Wellington managed to get dispatches back to the British government. He used that knowledge by going onto the British stock market and selling shares. The brokers, assuming that Britain had lost the Battle of Waterloo, jumped on the bandwagon, sold their shares for whatever they could get for them. Whilst creating this negative inertia, Rothschilds were secretly buying. When the outcome of the war was publicly known, and of course Britain won the encounter, the value of the shares recovered and soared. So Baron Rothschild was reported to have earned 20 to 1 on his investment. As you can see, information gave him the edge, but inertia made him the profit. Many academics, including Burnham, claim that inertia drives prices rather than information, and hence they encourage us to buy the unpopular stocks. Warren Buffett is a great example of how this works in practice. An extensive study found that when investors sell a share, the share they sold overperforms the market, and the share they buy underperforms. Okay, this has been a really quick and dirty look at finance, but the lessons are our patterning brain, the lizard brain, the amygdala, makes us ill-equipped to deal with financial markets. Markets are not efficient and hence punish poor decisions. If you believe this analysis, then you should avoid tactical allocation. This brings us back to where we started. How do we actually use a strategic allocation to help us avoid the amygdala messing up our investment decisions? Okay, let's get back to the table we started with and let's transfer that data into another table. Strategies can be very complex, but all I'm suggesting is you determine a strategy using the prefrontal cortex. In other words, now when there's no stress. As soon as stress comes, the lizard brain takes over and makes us make poor decisions. So we make a strategic allocation now and we stick to it when times get tough. All right, there's the data across in the other table, and we've taken property out of that. So we can see that his new value with the property out the portfolio is 55,000. Let's work out the percentages now of that new value. So we divide 55,000 by 11 and we get 20% of the portfolio, and so on, 13%, 16, 13, and so on. We check those percentages at the end to make sure they total 100. Now let's put in our strategic allocations. This is just the allocations we want to balance to. We've determined that Australian shares, we want 25% of that portfolio, 10% in cash, 12.5% for Australian bonds, 12.5% for international bonds, and so on. And again, total those out to 100. Okay, so now we have to work out what our new balances are according to those allocations. We simply multiply the target percentage by the total investment. So here we're multiplying 25% by 55,000, and our new balance is 13,750, which means we have to buy 2,750 to balance that portfolio. So we are currently owning 11,000, we want to own 13 odd, so we buy 2,700. And this carries on through the table. So 10% of 55,000, and therefore we have to sell 1,500. 12.5%, we have to sell 2,000 and odd, and so on down the table. Finally, make sure that those balances are correct, make sure they total 55,000. Okay, that was a bit mathematical towards the end, but I hope you can see the process. All you would need to do then is contact your fund manager and adjust those balances. Make sure that the fund manager is not going to charge you for this work, or if there is a charge, it's reasonable. It might be a reason to change your fund if they do charge. And of course, some fund managers do this automatically. That's the quick and dirty on behavioural finance and how to build a strategic portfolio. After the break, we'll be talking to Andrew about how that works out in practice. I'll see you then.